The United States Treasury has just executed a financial maneuver so extreme that it has fractured the bedrock of the global economy in a move that defies all conventional diplomatic and economic logic. The U.S. government has effectively banned Canada, its closest ally, largest trading partner, and fellow G7 democracy, from accessing the U.S. dollar clearing system. The immediate fallout hasn't just isolated Canada. It has detonated the foundational premise that the American dollar is a safe, neutral, and universally available reserve currency. The response from Canadian leadership within the first 48 hours was swift and devastating, permanently altering the trajectory of international finance. But the true measure of this crisis was articulated by Warren Buffett, the Oracle of Omaha, who issued a public condemnation so severe that it sent shockwaves through global markets. When Buffett speaks about the dollar with such profound alarm, you know the issue isn't about Canada anymore. It is about whether the dollar can survive the damage being inflicted upon it from within. To understand the magnitude of this event, we have to look at the exact mechanism of the ban. Late on a Friday evening, the classic political window for burying explosive news, the Treasury Secretary signed Executive Directive 2026-0147. This directive restricts Canadian government entities, crown corporations, and state-affiliated financial institutions from accessing the two systems that form the central nervous system of global finance: CHIPS, the clearinghouse interbank payment system, and FedWire. These networks process virtually every dollar-denominated transaction on the planet, handling trillions of dollars daily. By cutting Canada off from these pipes, the Treasury effectively declared that Canadian entities can no longer use the U.S. currency for trade, reserve management, or international settlement. Canada's energy exports, its pension fund operations, and its central bank interventions are suddenly devoid of their primary financial mechanism. The justification provided by the Treasury is what makes this directive historically unprecedented. The U.S. cited Canada's recent trade agreements, specifically the CETA deal with the European Union and the Commonwealth Pact, as activities inconsistent with the dollar's role in bilateral commerce. The legal authority invoked to enforce this ban is the International Emergency Economic Powers Act, IEEPA. This is the exact same statute used to enforce crippling sanctions against hostile nations like Iran, North Korea, and Venezuela. Let that sink in. The United States just deployed its most severe economic weapon, designed to neutralize threats to national security, against a Five Eyes intelligence partner that has fought alongside America in every major conflict for a century. Historically, dollar clearing restrictions have been strictly reserved for rogue states or regimes under UN Security Council sanctions. The international community has largely tolerated these actions because the targets were universally recognized as hostile actors. Applying these punitive measures to a nation with a perfect credit rating and an impeccable record of financial conduct crosses a psychological Rubicon. It signals to the world that access to the dollar is no longer a neutral right based on financial stability, but a conditional privilege contingent on total alignment with U.S. political and trade preferences. The reaction from the global financial establishment was immediate and universally critical. Former Treasury Secretary Larry Summers called it the most reckless use of financial sanctions authority in American history, warning that weaponizing clearing access against an ally inherently destroys the system itself. Former IMF officials and central bankers echoed this sentiment, emphasizing that the dollar's status as the world's reserve currency rests entirely on the trust that it will remain unconditionally accessible. Kenneth Rogoff, a leading Harvard economist, stated bluntly that this belief in unconditional access just died, and beliefs once killed don't resurrect. The swift and decisive counterstrike from Canadian leadership demonstrated just how prepared they were to exploit this strategic error. Given a 90-day window to wind down their dollar operations, Canada effectively rendered the dollar irrelevant to their sovereign trade within 72 hours. The Canadian Prime Minister convened an emergency cabinet meeting and subsequently announced a comprehensive five-part strategy on national television. He declared that the U.S. had proven the dollar was a weapon and Canada was responding accordingly. First, Canada immediately shifted all its bilateral trade with the European Union, nearly $100 billion annually, to euro settlement. Second, it accelerated the deployment of a multi-currency Commonwealth settlement platform, moving trillions in projected transactions away from the dollar. Third, and most alarmingly for U.S. financial dominance, Canada introduced the Canadian Dollar Internationalization Program, CDIP. This initiative involves issuing sovereign bonds backed by Canada's immense physical assets, its oil sands, potash reserves, timber, and critical minerals. Within hours, major central banks, including the European Central Bank and the Bank of England, signaled their intent to hold these commodity-backed instruments as an alternative to U.S. Treasury bills. For 80 years, the U.S. Treasury bill has been the undisputed safe asset for global reserves. Canada just introduced the first viable commodity-backed sovereign alternative, fundamentally challenging the U.S. debt monopoly. Furthermore, Canada established massive bilateral currency swap lines with the UK, the EU, India, and Japan, securing hundreds of billions in non-dollar liquidity almost instantly. Finally, Canada called for an emergency global summit for nations concerned about dollar weaponization, an invitation quickly accepted by dozens of countries. The U.S. ban, intended to isolate Canada and punish it for exploring trade alternatives, instead galvanized a global movement. Canada's actions were no longer viewed as aggressive de-dollarization. They were recognized globally as necessary self-defense. But the final fatal blow to the dollar's perceived invulnerability came from Warren Buffett. In a statement released through Berkshire Hathaway, the legendary investor issued his most severe critique of U.S. financial policy in his 60-year career. Buffett stated that he could no longer, with full confidence, call the U.S. dollar the safest store of value in the world. He compared the Treasury's directive to the catastrophic decision to close the gold window in 1971, warning that weaponizing the currency against an ally tells every nation on earth that trust is conditional. When Warren Buffett, a man whose fortune is built entirely on the stability of the American financial system and whose company holds hundreds of billions in U.S. treasuries, expresses fundamental doubt, the global markets listen. The market reaction confirmed Buffett's warning. Berkshire Hathaway has aggressively reduced its dollar exposure, shifting massive capital into Japanese trading houses, European financial services, and most shockingly, gold. Buffett has famously mocked gold for decades as an unproductive pet rock. His sudden accumulation of gold is the ultimate indicator of lost faith in fiat currency. This isn't a minor portfolio adjustment. It is a structural exit strategy from American financial instruments. The immediate economic blowback on the United States has been severe. The U.S. dollar index suffered its largest two-day decline in years. Treasury yields spiked as foreign holders began dumping U.S. debt, directly impacting American mortgage rates and the housing market. Foreign central banks withdrew a record-shattering $84 billion from U.S. reserves in a single week. Major American banks lost billions in projected clearing fees overnight. U.S. exporters, particularly in the agricultural sector, are now facing massive currency conversion costs and settlement delays when dealing with their largest market. The financial friction introduced by this ban is taxing thousands of American businesses and workers. The global cascade of de-dollarization has only accelerated in the wake of the directive. The Ottawa Accords, resulting from Canada's emergency summit, established a unified consensus among 42 nations that alternative multilateral clearing systems are a global priority. India accelerated its rupee settlement agreements. The European Central Bank expanded its euro clearing capacity to absorb the fallout. Most consequentially, Saudi Arabia explicitly broke the 50-year-old petrodollar agreement, announcing it would accept euros, yuan, and rupees for oil purchases. The petrodollar system has been the linchpin of global dollar demand. By severing this exclusive arrangement, Saudi Arabia declared that the dollar is now an optional currency in global energy markets. This crisis represents a phased transition in the global financial system. The U.S. Treasury's attempt to use its most extreme sanctions authority to enforce dollar dominance has achieved the exact opposite. It has proven to the world that reliance on the U.S. financial infrastructure carries an unacceptable political risk. By weaponizing the dollar against its closest friend, the United States has forced the global community to rapidly construct and operationalize the alternative financial plumbing they had previously only discussed. The trust that underwrote the American century has been broken, and the infrastructure of a multipolar currency world is being laid down in real time. The dollar hasn't died, but its unconditional immunity is gone, and the consequences of that loss will reshape the global economy for generations.